This is the April 25 edition of Commodity Week.
Todd Gleason's services are made available to WILL by University of Illinois Extension.
Well, welcome to Commodity Week. I am Todd Gleason. Our panelists for the day include Logan Kimmel. He's at Roach Ag Marketing out of Naperville, Illinois. And John Zanker is here from Risk Management Commodities in Carmel, Indiana. Thank you, gentlemen, for being with us. Let's get started right away today. I'd like a list of items that we maybe should discuss for the afternoon. Logan Kimmel, I'll start with you. Anything top of mind for you today?
Yeah, I think what we've seen, the trend here this week and playing out today is the strength in the wheat market that's leaked into the corn and soybeans. How that relates to and given opportunities to folks with some old crop contracts coming off the May here as well, with options expiration and first notice day here next week.
And John Zanker.
I'd like to focus today on soybeans, especially. We still have a respectable price. It's nothing exciting compared to what we've seen over the last 3 years, but our acreage is increasing this year. It may increase by another 1 million acres on the June report. Wouldn't be shocked to see that. Planting is going well so far. So we're set up for record yields, and if we do that on an acreage above 87 million, we could have a 9 in front of soybeans by October 1st. So I think that we're in a pretty important time to be focusing on getting some prices, some floors set in on our 2024 crop.
So your $2 drop really is hinged on the increase in acreage in the United States. Is that correct?
Well, a big portion of it is, but we've had a hard time getting our yields up here the last several years. We get off to some good starts, and then, how many times have we turned dry in the second and third week, fourth week of August here in the past several years? So we just can't get that yield up there to really even trend yield. So we're way past due for a breakout in yield, and if we have that, it really looks like 54, 55, something like that. So market's obviously not prepared for that, and shouldn't be. It's still very early. We still have most of the crop to plant, so there's a long way to go.
Earlier in the week, Joe Jansen, Scott Irwin, and Joanna Colusi pinned an article for the FarmDoc Daily website. It's still there. Mostly you look for USDA versus CONAB in the title, and you'll find it. It's about the difference of opinion that the two agencies, the one here in the United States and the one in Brazil, have related to the size of the total production of soybeans in Brazil. They make a case that it is about the consumption side, mostly about exports as well within that article. And in it, as they wrap up, they mostly say that the trade is focusing on the USDA numbers at the moment, and that their expectation is that the USDA numbers, based on the research that they've done, are more likely right than wrong, or more right than the CONAB numbers. And the CONAB will have to adjust something within their supply and demand tables to make the very small amount of carryover in that nation work right. I go through all of that because I asked Joe Jansen a question, John, at the end of the conversation he and I had for the Wednesday closing market report, which conjectured that the current price of soybeans at that 1170 area for November felt awfully good and both awfully stable if the trade was really using the USDA numbers. I think you're there with that, except that you have the caveat that when the fundamentals change and you believe they're going to change, the market's going to go down. Is that right?
Yes. CONAB is quite a bit lower than the USDA. Bevan Everett with Stone X just touched on this yesterday. basically saying that the cash market's the basis, and Brazil export pace and so on would suggest that the USDA is closer than CONAB on these bean numbers. So historically, you would think, well, CONAB's down there. So, and USDA's been slow in the past to bring down yields at times. But in the end, they've often been more accurate than what CONAB has been. So I would say that, even if CONAB's right, that's the second largest bean crop in history for Brazil. So it wouldn't be necessarily a small crop, but the difference in bushels is significant. If CONAB is right, then we're going to have a pretty big crop here to push prices much lower. So I would lean toward the USDA coming down a couple million more ton, which is not insignificant, but 1 million ton of that is probably going to be eaten up by our export sales and shipments coming in about 1 million tons light of what the USDA is currently projecting. That's what the current pace is suggesting, and I don't see any reason why the pace is going to gain from this point forward. So I'm mostly worried about adding another 1 million acres, and I'm worried about adding 2 bushels to the acre in that final yield, and that takes the carryout over 500, maybe close to 600 million bushels, and we just haven't had to deal with that since 2020.
Logan, Kimmel, are you and Roach Ag Marketing also worried about no crop soybean?
Yeah, I think those are all very good points, and a couple different approaches to that or sides of that. One, Todd, that article you sent out is very good. I'd recommend anybody that hasn't taken a look at that to go over it and see the differences in the accounting in the stocks to use from CONAB to the USDA, and the how that overlays the differences right now between the size of the crop. But overall, it's still potentially a very large soybean crop in South America, and I think the exports have alluded to that or lack thereof here. Now, if you look out on another side of things to our bean crop, new crop here, yeah, I think things have gotten off to a pretty good start. Folks talking down by Springfield, producers in that area are moving quite along and even starting to see some beans emerge with rains coming through this weekend. So I think that if we do see a relatively stable growing season and our exports stay where they're at with a large South American crop, we could potentially be set up for quite a bit lower soybean prices come harvest in fall time, and a very, very well supplied balance sheet on top of that.
I will remind folks that they can find the article that Joe Jansen, Scott Irwin, and Joanna Calusi penned on the FarmDoc Daily website. You can also find it at willag.org. You'll just have to look through the list of story headlines there for USDA versus CONAB. And if you hit the USDA reports page at willag.org, you'll find the current CONAB supply and demand tables, and it is in million bushels rather than in million metric tons, which makes it easier for me to understand. So I convert that, and there is a difference between the USDA reported numbers and the WASDE figures because they operate on a global marketing year. And the numbers that you see from CONAB in the supply-demand table, which operates on their local season. And that difference is simply this: in the global numbers, you will see a current carryout, I think of 20% stocks-to-use ratio. But the USDA has a second set of numbers, which has the same kind of carryout number, which the CONAB folks use. I believe it's 1.5% stocks-to-use ratio for the USDA and 1.7% for CONAB. Those numbers are drastically low, we would be in the $18, $20, or $25 range for soybeans if we were that low. Maybe even higher. Those numbers are just interesting. I do want to continue on with this soybean discussion. And Logan, last year, one of the issues that we had and still have with the marketing year supply and demand tables is that the soybean crop in Brazil was so very large, and China has been determined, I believe, to import from other places than the United States, that it's squeezed down the length or time frame available for U.S. soybeans to be exported to China, and that has caused issues with the supply and demand balance sheet. Will that continue for this marketing year? Do you think it will continue in the new crop marketing year for soybeans?
Well, yeah, and I think we're starting to see that, or have been seeing that, especially today's numbers, and even looking out to the new crop. There really just isn't much in the books yet, and I fear that I continue business from China in Brazil picking up, and we're not seeing that here shift back to us. So yes, that's a headwind, as well as the U.S. dollar, which has recently been on a move higher. So that is another headwind. Until you really see the Chinese purchases from us start to pick up in bulk, that could be an issue in looking out to the 2024 and 25 exports coming forward here. So that's something to be mindful of moving forward. The larger South American production that probably provides cheaper beans from Brazil as opposed to here in the U.S.
For both of you, and I'll start with you, John, on this, does this mean there are actionable items related to maybe even old crop if you have it, but particularly new crop soybeans? Do they need to put cash fall delivery offers in? Are there other things that they should be doing?
Well, we've got a pretty stout put position on currently, and just the idea we've got to lock in a level, and we've identified that to be in that 1150 area to just say, hey, we're going to set a floor on the bulk of this crop this spring. Hopefully, we'll get a chance to do a little bit more here in the next 2 to 3 days. But in addition, selling cash or selling hedge to arrives, locking in short positions at these levels, while not very appetizing compared to what we've seen. If you plug in 65, 70, 75 bushels at 1150 cash, 1125 cash, there's still some room there. There's not a lot of room with corn at 475. And so, we've kind of taken the idea here that we're going to focus on one, maybe a little bit more heavily on the other. As far as getting some lows locked in, there's some pretty good evidence from the past that 32 out of the last 34 years. My friend Jody Lawrence dug this up. 32 out of the last 34 years, December corn has come back and traded higher than the January high, and I believe that was 502 3/4 on January 2nd of all days. And in 33 of the last 34 years, November futures have come back and closed above the January high, which I believe was 1237, and I think we got the 1227 on that last push. So we use that to get a few beans on the books, and but we need to be careful. We don't have to look back very far. It's been easy to try to hold on here the last 6-7 months, hoping for something better, and it's just not really come around. So it can get worse. We know that. And so we have to be careful here and look at getting some bottom set in on a good portion of this bean crop.
What has Roach Ag Marketing been telling producers about new crop soybean sales?
Yeah, I think if you look at the past week, going back, not just soybeans, but even corn, we've had a good stretch from the close last Thursday on these grains. So if you're a producer who maybe needed to catch up December corn here has rallied 16 cents from the close on Thursday, and November beans settled close to 11.50 up here now to 11.75. So there has been a move here. Maybe it's due to some of these other outside markets. We saw some intraday strength in the crude oil today, and that helped prop up and get the soybean oil off its lows and kind of correlated with the soybeans. So I think if you see strength like that, like we did today, and it gives you an opportunity to start adding to and putting some floors in on some of these new crop levels, I think you have, as a producer, you have to take advantage of that. And that might be in the midst of, we might be in the middle of one of those opportunities to do so on these new crop contracts.
Logan, you wanted to talk about the wheat market and the strength in that market as of recent times. I'm wondering what fundamentally you believe is pushing that. And then, of course, we can relate that to the old crop contracts, if you'd like, for corn and soybeans and other products.
Yeah, definitely been some action volatility here in the last week. So I'm not entirely sure it's solely based on fundamentals. There's been fundamental headlines in this wheat market for a couple of years, and it's just been sold. But we have started to see more geopolitical risk pick up, some weather worries in the wheat belt, southern Russia and Ukraine. Maybe not as much grain flooding the market out of the Black Sea region as there has been here in the last 2 years. So looking at lower global supplies, I think there's a story starting to develop. But what I think has sparked the market or pushed it is the spec funds have started covering some of these large short positions in wheat. Now that's provided a rally above levels on a chart, and on technical levels, to me, that would trigger some more short covering. So it's been a good stretch here in the wheat market of fund buying, and I think that's helped support this corn and bean market as well. So for producers that have to make some decisions looking on corn and beans on some May basis contracts, this is a better spot than we sat here a week ago, and we've gotten a nice rally here in the grains to make a decision on either pricing those out or rolling to a further contract.
John Zanker, far and away, the northern hemisphere supplies the bulk of the wheat the globe might use in any given year. There are issues related to wheat in the western United States. Are there other places that you've been watching that might be worrisome?
Yes. We do have a developing problem in Kansas and Oklahoma in particular. We've got some Black Sea problems, both Ukraine and Russia, looking at maybe a downturn in yield. India is concerned that, they'll be importing wheat this year. So, and I believe France, I think Logan mentioned Europe. I think maybe France in particular is seeing ratings pretty far below what they typically would see at this time of the year. So there are some production concerns. I would say, we're going to sell some wheat into this. One of my customers today, not too far from Champaign, said, "Hey, let's put some 2025 on." So we hedged up some 2025 wheat. I hadn't even been paying. I hate to admit it, but I hadn't been paying a whole lot of attention to that because I still have more than I would like of the 24 crop to sell. So there's a big premium out to the. We got some sold at 685 futures. So I like to sell premium. I don't typically go out and sell the next year crop if it's at a big discount to the current year crop. I always say, hey, if we still have old crop to sell and it's at a premium to new crop, why are we worried about the new crop? A bushel's a bushel. A bushel is a bushel. The only difference is when it's taxed, in my mind. So I think we need to take a look here, keep an eye on this 2025 wheat, and if it presses up into that $7 area here in the next few days, we're going to push that. Maybe a little harder than our 2024 sales.
Is the wheat rally limited, which is what I think you're telling me, by just the fundamentals in the wheat market? Is it a problem with the other coarse grains, corn in particular, or something else?
Well, I was in junior high in the early 70s when we had export shipments this bad. So, it's been a long time, and we're just not competitive. I mean, Russia is just kicking us all over the place, and the rest of the world as well. So, if they do see a yield decline, if we could get that production number down, and Ukraine's number is probably going to be down, that's a start. And then if we see some problems in India and France, and our yields go down, we're on the way to another spectacular soft red crop, I believe, at this point. And I thought we were on our way to a really good hard red yield, but the past 30 days have not been good precipitation-wise for Kansas and Oklahoma in particular. So we may see our production cut back, but, any rally here, we're currently 80 cents off the low on July July wheat from back in early February, I believe. So an 80-cent rally probably needs to be sold. I wouldn't get super aggressive here until we see some of these other things develop.
Because, Logan, wheat has grown across the planet, there's a harvest every month of the year. Traders tend to like it to lead because if it is rallying, it can pull markets up month after month after month. I think John's telling me that's probably not going to happen. Do you agree?
Well, I think John brought up a good point. We've had an 80-cent rally in a very short amount of time. A setback wouldn't be uncommon, and if that happens, you might expect other markets or other grains to maybe follow suit back to the downside. So just looking at some very basic technicals, you're approaching 200-day moving averages on these July Kansas City and Chicago wheat. That might be in the short term, maybe a cap on this really nice rally. So any folks that have been looking at this market to get something done from a very basic technical standpoint, you might find some selling pressure or a halt to this move and maybe a setback from those levels. So yeah, it's been a good stretch, but I think that's something to keep in the back of everyone's mind.
And finally, turn your attention, and Logan, I'll start with you, on to the corn market and what the fundamentals are telling you, and what old and new crop pricing strategies farmers should still be considering.
Yeah, on the old crop, we've seen this market really just be range bound, and that goes back to where we established a low there for the time being in February. So it's been choppy, and I think the market right now has been propped up with the wheat. So any folks that have been holding on to some old crop and maybe need to catch up, this has been on May corn, about a 15-cent rally from last Thursday. So we're at a level here where I think you do have the seasonals on the side of usually getting a rally between now and July. You've also got the spec funds still heavily short in the corn market. That goes for the beans and the wheat too. They're starting to unwind some of those. So if we can get more of an extended short covering rally into the seasonal time frame here, I think producers have to look at making marketing decisions on the remaining old crop bushels, and then jump into this new crop as well. Same thing. It's been range bound up to this 480 level on the top end, being resistance, and 460 your bottom end. So when we're talking about November beans, I think producers on the corn side need to be considering these levels at the top end of the range, especially if we were to break out a little bit above this 480, having orders in above the market into the seasonal time frame. We usually get some good marketing opportunities. I think that's a good plan here between now and say the 4th of July. So overall, I think this corn market has been range bound. We've seen it here the last 5 days move up to the top end. So while folks have been busy here in planting and maybe not been watching or paying attention to these prices, we have gotten a little bit better opportunity since last week.
And John, do you have things you've been talking to producers about as it's related to the corn market this week?
Oh, yes. I put out in my commentary, if you still have anything on a basis contract, I think it's time to say, this is it. Use this rally, get that priced. If something comes up, if we get into a delayed planting or we get into a drought scare, we feel that coming on, maybe we'll replace some of those old crop sales, the final sales. But, there's always comes a time, and it's usually some point in the spring, where you have to let go of the old crop and start focusing on the new crop. And I've never really been big on re-owning a lot of the old crop, especially when you get to this stage. And, where's that money for options, puts and calls best spent? So one thing, this Argentine leafhopper thing is kind of interesting and something certainly that we're keeping an eye on. I've been at this thing for, it'll be, 43 years next month. And over the years, disease scares, windstorm scares, those were overblown pretty much 99% of the time. So until August of 2020, when we had a hurricane move through Iowa, and about the same time the drought had gotten started. So I saw that with my own eyes 3 times. So now I pay a little bit more attention, and StoneX has put the losses maybe as much as 7 to 10 million tons. If it even approaches that 7 million tons, I think that's eventually worth 30 to 40 cents on December corn. Now, can we get that scare going before we actually see those harvest numbers wrapped up for Argentina? I'm not sure. And the trade will focus next week on planting pace, I believe, more than anything else. So I am concerned about the downside here. And with any old crop, I'd be using this rally to get things wrapped up there.
Let's get a final word from each of you. Speaking of wrapping up, Logan Kimmel of Roach Ag Marketing out of Naperville, Illinois. We'll start with you.
Yeah, we've seen some action here in these markets led by the wheat. If we can get that to continue, just a reminder to folks that we are coming into a seasonal time frame where if the market gives us some opportunities to clean up the old crop and start looking at that new crop, they might be quick opportunities, whether that be a short covering rally or maybe a weather event here. But I think big picture, producers need to look at their bottom line and consider where we're at on our balance sheets and how that might look this fall if we do have a trend line yield. So take advantage of opportunities between now and mid-July in our growing season and make sure to stay on top and protect these levels.
And John Zanker of Risk Management Commodities out of Carmel, Indiana.
I don't know if I can add a lot to that. I think that's really sound strategies. And again, I just, again, focusing on the beans are a little bit harder than what I am on the corn. Certainly we've got the capability now of seeing corn yields in the mid 180s. So even with an acreage drop, we could put a pretty good addition to the corn carryout, and we could possibly get futures with the 3 in front of them. So that's certainly not out of the question. I just ran some numbers on beans there just a few minutes ago, and if we harvest 87 million acres and we put a 54 bushel bean yield on it, and we're probably capable of 55, but if we did a 54 and used usage from 2 years ago on beans, which was 200 million more than this year, we're looking at a carryout in excess of 600 million, maybe pushing towards the 650 area. So we've got to be, when we're talking about beans with a 9 in front of them, I'm not saying $9 beans, but I'm saying $9.75, $9.85, $9.95, whatever. It's a lot lower than where we currently are, and we need to be concerned about getting some floors set in.
Commodity Week, of course, is a production of Illinois Public Media. It's public radio for the farming world. Find us online at willag.org. That's willag.org. Our thanks go to our panelists this week, Logan Kimmel of Roach Ag Marketing and John Zanker of Risk Management Commodities. I'm University of Illinois Extension's Todd Gleason.